Welcome, everybody, to another episode of Canadian Mortgage Hangout TV. My name is Gord McCallum here in Edmonton, Alberta with First Foundation Mortgages. I'm joined this week, as always, by Jackson Middleton, the Kilted Broker out of Regina, Saskatchewan. How are you, Jackson?
Doing well, thanks.
Good, and the always entertaining, lovable, sometimes willing to push people a little too far, Rob Campbell. He's a man with a smile, a man with a plan. How are you in Guelph today?
We're doing wonderful in Guelph. Thank you, Gord. Hello, gentlemen.
Good to see you, Rob. And Scott Dawson, as always, a little hairier this week than we've seen him in the past, but it suits you. You've got the air of a sophisticated Wall Street executive. I think you could manage my stocks any day, Scott.
There we go. Thanks, guys.
All right. It's a good thing I don't have any stocks, though. So now, gents, for those of you tuning in this week on CMH TV, you can follow us on Twitter at #CMHTV. We'd love to hear from you. If you want to send us your requests, feedback, compliments, complaints, insults, it's all fair game. And if you're following this live or recorded on Canadian Mortgage Hangout.tv, we'd love it if you'd share the love a little bit, tell people about what we're doing here, and hit those +1 buttons or the Facebook likes and get the word out there to our fellow mortgage brokers in the Canadian industry. We want to continue the conversation and work towards always improving our industry and have a little fun while we're doing it. So, gentlemen, this week, big controversy. It seems like every week, lots to talk about. This week, the big thing on everybody's lips in the news is compensation. Brokers, most of us do what we do because we're selfless human beings who would really volunteer to do this anyway. But the truth of the matter is we all have families to feed, and compensation is a big thing. We want to make sure we're paid appropriately for what we do and the value we bring to both the consumer and the lender. So would somebody care to summarize? Maybe Scott, would you care to summarize for us what's going on in the world of compensation and mortgage land right now?
He's muted.
Oh, you're muted, Scott.
You're muted.
So, see, I can follow my own rules. It even tells me. Look at that. Late last week, was a First National announced that they were reducing broker compensation by a little bit, and also taking away some of the I forget what they call it, the marketing dollars that they offer with points, basically. That's kind of the gist. I mean, it wasn't a huge cut, but obviously I don't think they're going to be they haven't really been the first lender, but they're not going to be the last either. Okay.
Now, they talked a little bit about their justification, because obviously I'm sure they didn't make this decision lightly. It could affect their volumes if brokers don't feel like they're being compensated fairly by any lender. That could potentially affect their volumes, and it's a competitive marketplace out there. Do you feel, Rob, like this is going to affect First National's volumes? And maybe to take it a step back, does this make them less competitive now, or are they still sort of in the marketplace as far as you're concerned?
Great question. I think they're still in the marketplace, but I definitely think you're going to see a lot of brokers maybe reevaluate how much business they might place there versus other lenders. But I don't think they're out of the game. I mean, the spending, the whole marketing account or spending account, whatever you want to call it, the wizard account, that's going to be huge too, right? Because that's one of those perks of placing a huge amount of business with them that we saw first line drop off the face of the earth with their benefits, and now we're kind of seeing the same. The cost of business is increasing, risk is increasing. And I think we're going to see a lot more of this kind of stuff to come from other lenders as well, unfortunately.
Jackson, what's your take on, and maybe you could summarize a little bit what you think First National's perspective is on this and why they felt the need to cut the compensation the way they did?
Well, I think there's probably a lot of factors, and there's probably more that they know that none of us do. But I mean, if you break down the First Nationals compensation, from my understanding, they were typically leading the industry in compensation anyways. I mean, total package, when you deal with brokers' front-end commission, the corporate volume bonus, and then, your wizard spending accounts and your wizard bonus, I mean, they were upwards to the top end of the range. So by cutting back by 5 basis points on their broker commission, yeah, they're less than somebody else's 80. They're at 75. But I mean, total package, you're still getting roughly the same as what you would at another competitive lender. They cited that volume pooling had a lot to do with it. That's independent individual brokers who might do 2 or 3 deals a year. They pool their volume together with maybe a couple of big producing brokers, and they get paid the same. The problem is when you're dealing with a broker who works full-time, knows the business, streamlines their deals, they're going to be considerably more efficient, less time for the underwriter to look at the file. When the underwriter can turn out more business, obviously, First National becomes more productive. The more productive, the cheaper it is to do business, right? So when you get these pooling, you get these, part-time brokers who don't really know what they're doing, phoning up the underwriter 400 times in a 1-week period, it's wasting their time, so they're not as productive. Should that broker have the same access as a broker who, is more of a professional? I guess that's what they're trying to do. So that's kind of, I mean, those are a couple of things that I'm looking at. My take is, if we were more efficient as a broker channel, I don't know that First National would be in this place to have to do this.
Okay, well, that's a very good point. I had an interesting conversation with him yesterday, and from my understanding, it sounds like, originally the Wizard spending account, which is the account Scott was talking about, which designated a certain dollar amount that every broker over a certain volume would receive on deals to help out with marketing expenses or other kinds of business expenses. Originally, that was designated sort of for the top 20% of brokers, and I think they're going by the 80-20 rule here, that 20% of the brokers would submit 80% of the volume, and they wanted to make sure that those top 20% of brokers were well incented and properly compensated for that. But because of the pooling, essentially they were paying everybody for the volume that maybe should have only been coming through the top 20. So I can see from that perspective, and the full disclosure here, I've always been a big First National supporter. I think they've been a good lender, and their position in the marketplace indicates that. To me, they've been the most consistent of all the lenders I've dealt with over the last 10 years in the business. So kudos to them for that. So I think you're right. It doesn't really drop them below other lenders from a compensation standpoint, but maybe doesn't make them the highest paying either. So it's painful. It's going to cost us some money for sure. However, is it justified? Probably, and I can understand why they're doing it. So hopefully these short-term pain things are for long-term gain in the industry. Now, let me ask you this. How much does compensation weigh into your decision to place a deal with a particular lender? And we'll go back to Jackson and work our way out to Scott.
Obviously it's going to play some factor in it. I mean, if it's completely skewed and one lender is willing to pay you more to do exactly the same business, well, of course. I mean, I'd be lying to say that you don't look at it, but honestly, I have to evaluate my client's needs first. And for me, I create my value proposition based on service. And for me, service time to my client and to my realtor partners that are referring the deal, I want turnaround time. I don't care how much money I'm getting paid, because if I know that one lender who's paying me even half what the other lender is can turn it around in 24 hours, I'm there, because then I'm going to impress my realtor, which just generates more business. I could care less about 5-10 basis points here and there. I want a good quality lender who's going to work with me to provide a service to my clients. And it's the same thing can be said with rate. I mean,
sure.
Okay, yeah, you give me 2.89, but it's going to take you 2 weeks to turn it around. I'm not impressing anybody. So, I'm looking for that partnership with the lender that says, we're going to work together and we're going to be able to take care of the people that refer you business.
Rob, same question. Have you ever been in a position where you felt pressure one way or the other to submit a deal to a particular lender, maybe because they pay a little bit more?
I think in the past, yes. Past being when I first started, obviously, because there's those growing pains. To be quite honest with you, exactly what Jackson said is 100% of what I would have said anyway, and that's my thought. Whether it means 80 beeps or 100 beeps, I mean, now we're not going to cut ourselves short and say that the highest payers should reduce down to 80 to make it all carte blanche. But what I'm saying is exactly what Jackson said. If I can get a turnaround time of 24 hours on a commitment, maybe 24 hours or 48 at the most on doc fulfillment, that's where I'm going. We cannot, as we're seeing now in the marketplace, rates are starting to get really aggressive, or they have been aggressive with the branches. So really the rate game is a slippery slope, and as Seth Godin pointed out the other day on his fantastic blog, the race to the bottom, you don't want to be the first to the bottom because it's a hard landing. Speed, that's all I'm about. Is speed and efficiency, but it goes right back to to our lender partners, right? They'll be able to turn around that speed if we are also being efficient for them, submitting clean deals, submitting really good detailed notes, submitting solid clients to the right lender, not sending them to 3 or 4 different lenders. Just slam dunk it, give me my commitment, and once that underwriter knows, oh, Rob's deal just came in, I know from my past with him, he's going to fund this deal because he sent it to me. I'm going to slam dunk this for him. That's it. It's speed. So I wholeheartedly agree with Jackson. Scotty, go.
Yeah, no, same point. I mean, thinking back again to when I was new in this business as well. I mean, I'm still relatively new, of course, but I never paid attention to compensation that much. I decided, I mean, even my mentor, that's how I kind of was trained is, I mean, worry about your client, worry about the product you're selling, learn about that, and the compensation comes later. If I'm servicing my clients properly, the compensation just flows from that. It doesn't necessarily dictate where I'm going to send it if I'm going to make more money somewhere else. And now I'm going to send a deal to the same thing. Like I'm going to send a deal. If it's the exact same compensation, the exact same rate, the exact same product, I'm going to send it to the lender that I can get it back faster from.
Well, it really
and gives me the better service.
It really begs to rewrite an old saying, but it's 100 basis points of nothing is still nothing. So I guess that
absolutely,
you got to be able to deliver, and you got to be able to deliver quickly. I think speed does win in this business. I know we've all probably won business from branch competitors who maybe have taken too long to return that call or get back with a commitment. So, and I know referral partners generally expect that as well. So. It's I think you're right. That efficiency, Rob, I really like the point you made about making sure that we're as efficient as possible. Before we went on the air here, we were having a little conversation off the record, but it was about templating our deal submission notes and making sure that, and that's probably a best practice that other brokers might want to consider. It's been a big efficiency boost for us in the office, and even just from a consistency standpoint. If I've got 3 people submitting deals, but they're all using the same deal note template, it doesn't matter, to the underwriter on the other end if they're working with John or Susie or Mo. The deal looks the same, and it's going to be well explained. And it also prevents those forgetful moments where we don't put something that's really important in the notes that we would have otherwise. That costs them time because they got to call us back, and we're trading voicemails and things like that. So having a good submission template is a good idea, and I think all of us practice that now. So that's something I'd encourage. Jen, so on the compensation side, do you think are there brokers out there who are submitting entirely based on compensation? Do you think?
Well, I'll jump in on that one. Yeah, you know what? I think there is. And I think that's probably the same reason that we get fraud in our industry. I think the problem is this is a really tough business to crack. I mean, I've been in it 5 years, and honestly, right now, I'm picking up a lot of clients that I was dealing with 5 years ago. If you're doing a standard 5-year term, it takes you 5 years before you're going to get some serious repeat business on renewals and stuff. So in your first 2 years, if you don't have money set aside, if you haven't prepared for this properly to get into this industry as a profession long term, it's tough. So when you're dealing with one deal and you got to close that one deal, yeah, you're looking at it, okay, where can I get paid the most? Because I got to stick around. I got to feed my family. And crap, if something's a little sideways, well, maybe I just don't tell the lender that. You know, I'm not saying it's right. I'm just saying that that's honestly probably one of the reasons for it. So are there brokers out there submitting purely on compensation? I would say, yeah, they're typically going to be a newer broker, or to open another can of worms, it's going to be the whole discount, you know, the whole building your brokerage on a discount model instead. You know, yeah, they're going to want the most money so they can buy down the rate and compete that way.
That's a good point. Now, guys, do you see this? I think there are some in our industry who are a little nervous, maybe a little more than a little nervous about this compensation drop from First National, and they see it as the first shoe to drop with other lenders. I'm not so sure that that's the case, because truthfully, if I think that if the broker channel lenders went, say, and paid what a mortgage specialist would earn at a big bank, I think our channel would be in trouble, and I think those lenders would be in trouble. So they're smart. They're not suicidal. They don't want to torpedo their companies, and we have to look at the economics of this. The reason why banks pay mortgage specialists less is because they also have overhead called branches that are expensive to run. And so you can't have both. Our lenders, the value proposition to them is they get volume without infrastructure and overhead, and that's why they're able to pay a little bit more, because it's a variable cost, not a fixed cost. That's just good business. It makes sense. That's why we talked about ING last week, was able to build their business up using the broker channel and issue quite a number of good quality mortgage loans. But is this a Jenga piece in the Jenga puzzle that's going to lead to more and more of those pieces coming out, or are we going to settle into a pattern of compensation that where pooling becomes less and less of maybe pooling is not incented in that way as it has been in the past, and the focus moves on to other things like efficiencies, apt to fund ratios, commitment to fund ratios. Is that where we're going, Rob?
First of all, good for you for using the Jenga reference. That was awesome. I do think that we're going to see efficiency be the biggest focus. I don't think that the compensation is going to come down drastically, if you will. I think moving forward, we're going to see a massive shift from, and this is my personal opinion, my crystal ball, we're going to see volume bonus kind of more into efficiency focused bonus, and maybe even not paid quarterly, but maybe paid semi-annually. Because if it's paid quarterly, you know, then you can kind of work the system for 3 months and then quickly shift somewhere else, right? Whereas if it's semi-annually, maybe there's more focus on efficiency, not wasting your time, but primarily not wasting the lender's time, because there's a huge cost association with even issuing out a commitment to you, never mind going through the whole funding process. So I think it's going to move more to an efficiency model, whether it be volume pooling or, you know, everybody submitting under one name, whatever, all that stuff aside. I think it's going to come down to efficiency, which is going to trickle down, right? If an agent at a brokerage is submitting under Jackson or you Gord or you Scott, under agents under you submitting under you, but they're sending in bogus deals that never get funded, you're gonna call them out on that.
Yeah, it would actually that would probably have the desired effect from the lender's perspective of getting less efficient brokers out from the submission queue, and because the teams will do that themselves. The guys leading the team, the men or women leading those teams, are going to call the weaker agents themselves and do the job that the lenders have wanted to do for some time, it sounds like. Scott, what kind of efficiencies do you think lenders should be focusing on, and any suggestions on or thoughts on how they might compensate us differently to kind of achieve their objectives and yet still allow us to make a good living?
Well, I mean, obviously, I mean, they're probably living off the same kind of standards that I am or we are. Is that when you send a deal into one lender, you're anticipating it's going to be approved and go towards funding, right? But that can start from, from a lender that takes a rate hold. If we're sending in a pre-approval or a rate hold, for example, First National, we get that rate held. I mean, efficiency-wise, we should be keeping that rate in there, no matter what. Once the deal goes live, and this is where it's obviously tough for brokers. Is you want to still give the client clients are still very rate sensitive, right, and rate driven. So an issue comes with efficiency that I find is when there's maybe a rate hold going in, and then when the deal finally goes live, I can get a better deal somewhere else. So I'm probably going to send it somewhere else. This is what's hard, and I think the lenders, a lot of lenders are to blame for this themselves by offering 45-day, 30-day quick closes. So they're almost kind of shooting themselves in the foot a little bit in some of the efficiencies.
Well, it's interesting you mentioned that, and pre-approvals are one of those things that maybe a lot of people, maybe some newer brokers may not realize this, but there's a cost to the lender to hold those rates, right? They're hedging, they're buying essentially, or they're putting a deposit down on a pool of funds, and that costs them money to hold those rates themselves. So, on one hand, I know that the lenders we do more pre-approvals with also get more funded volume from us. There's for sure a direct correlation in our business. I know not every broker uses pre-approval. Some use straight rate hold, some don't use them at all, and that's okay. But for us, our model requires us. We do a lot of pre-approvals, and the more we do with one lender, the better the volume is from us when it comes to funding. That said, maybe there are efficiencies to be found in how those pre-approvals are done. Or how those rates are held too, so the cost of hedging isn't quite as high.
Because really, what quick close? The market shifted a little bit though. Even the last year or so, there's a lot more quick. I don't even want to call them quick close specials anymore. It's like you get the lowest rates with the. It's kind of a normal now, But in the past, those were almost done by lenders to steal deals from other lenders. No, hands down. That's what they were for. I typically never use them because in my business I don't sell right on rate. I'm selling on a product and I'm selling on the features of a mortgage for a client. So it's not as necessarily rate driven, but there's times when that does come up.
For sure. Well, actually, I can concur with what you said about the speed of closing these days. 10 years ago when I started, I used to be able to look at my pipeline 3 or 4 months from today and have a pretty good idea what was going to close in that month. And now I'm looking at it month to month, and it is, it's really interesting. We could be 2 weeks out from a month and not really be sure what kind of volume we're going to do, and then it can pick right up. So I think things in general are closing much quicker. I think in Alberta, I can't speak for the rest of the country, but when we had the really hot real estate market in 06 and 07, I think that set the bar, and people just got used to doing things quicker. We had shorter condition dates. The realtors were looking for quicker condition date deals. Everything had to happen much faster, and the days of the 2-week commitment to conditions and stuff and 90-day possessions are gone. So maybe that'll moderate over time, but that's the way it's been for a while now.
See, I'm going to jump in here. I'm going to take kind of what Scott said. It's interesting. I've always been it's not uncommon for me to say I think as brokers we need to start working together. But it's interesting when you look at the lender climate as well, because they do. They cut each other's throats with these quick close specials. So as a broker channel, I just don't see us being all that healthy. We've got brokers who hate each other and just seem to race to the bottom, like Rob said. We're all waiting to, we're all going as fast as we can to sell rate, and you got lenders that are just kind of, okay, if the brokers are selling rate, well, we'll do a quick close special and steal some business from another lender. It doesn't seem healthy. It doesn't seem like we're moving in the right direction. I would like to put forward, we need to be more efficient as a broker channel. If we're going to deal with lenders who are offering products that they think that we want, what if we start really saying, hey, why isn't a lender out there saying minimum 80% fund ratio? Just use that as an example. If you don't do a fund ratio of 80%, you don't get to deal with us. And what that's going to do is that's going to increase their productivity. Brokers like me, I'm going to go, hey, if I got to keep an 80% fund ratio, but they're giving me a 24-hour turnaround, I care less about the compensation. I'm going there. And what you're going to do is you're going to attract the brokers who are like-minded. The problem is nobody wants to stand out and say, hey, I'm going to be different. Because what they don't want to do is lose some of the business.
Yeah.
I love some of these lenders. Go ahead.
No, I'm sorry. Go ahead and finish your thought.
I was gonna say, I mean, it's the same with rental stuff. You know, you get these lenders who they don't really want to do rentals because they never really approve any of them. You know, it's, oh, we can't have more than 3 rentals. Oh, we're gonna surcharge the rate. Just say we don't want rentals. Don't waste my time offering me a product that I don't want. Because what they're going to do is they're afraid that I'm going to take my business somewhere else and someone else is going to wow me. And because I didn't do one rental property at my #1 lender, I'm going to be moved over here. So they give me a crappy rental experience here. Drop the product. You know, the goal isn't to do business with everyone. Sorry, I'm ranting. Go ahead.
I was going to say, Jackson, I appreciate your point of view. I just wish you'd say it with a little more conviction.
Yeah.
Now, one of the things that, so when I listen to you guys, it sounds a lot like what we're saying here is that brokers bear some responsibility for this, and that we have to be efficient partners for our lenders, and we have to be doing good business and sending in stuff that's going to fund and keeping deals with the lender so their costs don't get out of line. But on the other hand, that there's a lender responsibility in there as well to incent the outcome that they want. And I know, you know, the last few years lenders have been saying it's not all about volume, but you know,
they incentivize on volume.
There's volume targets they want everybody to commit to. There are other volume incentives in place, and that's always been the you know, at least traditionally, the model. So maybe they're learning, as we are, that volume at any cost isn't where it's at, but we want to do good quality, profitable business. Any other lender responsibilities that Scott, you can think of to that you know, a lender should really put in place to make sure they're getting the kind of business that they want?
I mean, we talked earlier about the note, like templates, that kind of stuff. I mean, it would be nice maybe if, I mean, I can talk about an experience we had with one of the lenders that came into one of our monthly meetings, and all they talked about was their points and what they could offer with their points. There wasn't a talk about what products they offered and or how can we, what do they want from us, right? Like that's what they have to almost kind of get on board and say, this is brokers, this is what we want, you know. Instead, they just kind of putting out, this is how much you get paid, this is it, you know. They don't necessarily say what they're trying to achieve. Rob,
I hope someday we have the opportunity to play poker together, because you wear your emotions on your sleeve. It's all over your face. Tell me what you think about what Scott just said.
Okay, so if you fund $10 million and you hold a funding ratio of 20%, you're going to get a free bag of cedar mulch. What do you think about that? Come on. I want to submit it. Look at this is all I want. I want to submit a deal. I want a call or a commitment in 24 hours. Because if I submit the deal to you, you're going to get it. And I want docs fulfilled in 1 or 2 days when I slam you with all the docs, not piecemeal, but all the docs. And I want the file complete as quickly as possible. That's what I want. So lenders, I haven't been in this business forever. So some of you out there might be viewing this and saying, Rob, you're kind of talking out of your rear end. But all I want is speed, and I don't care about free, free mulch or a free case of water or a fancy dinner. I don't care. I want to make sure my end user, which is my clients, are happier than hell. That's it. That's it. That's all I have to say.
Well spoken, well said. I think that's probably a good one to end that conversation on. So brokers, get your act together, send your lenders good quality stuff. Lenders, make sure you're incenting the right behavior so that you don't have dummies like us sending you stuff you don't want, and we'll all get together and celebrate when the market and channel is stronger than ever. One last thing here, guys. Now, before I go, this is another one. I'm going to throw you guys a curveball today. We didn't talk about doing this, but I'm holding in my hands, my hot little hands. I don't know if you can see this. CIBC. Oh, let's see if I can do it. CIBC came out with a report written by their economist Benjamin Tal that says Canadian housing demographically dangerous.
Dun, dun, dun.
Dun, dun, dun. We're all getting older, and what does that mean for housing? So it's it's the reason I bring this up is because it was fun watching on Twitter this morning that people started talking about this, and depending on their political point of view or their market point of view or the point they've been trying to make for months, if they were a bubble believer, this report was verification of their theory. If they were somebody that said, no, the market's strong and it's going to be fine forever and it's going to be perfect and nothing to see here, this also verified that for them. So I don't know if you guys have read it or not, but the summary is we're maybe in a period of soft correction, which the correction people, the bubble people, were all over. That's the first paragraph. And the rest of the thing talks about how the demographics of our country imply continued strong demand in the coming decade. So short-term pain, long-term, at least 10-year horizon implies reasonably strong demand for housing. So anybody has anybody gone over this yet? It just came out this morning as far as I know. Yeah, it's dated August 23rd, fresh off the press. What are your thoughts?
And silence. I haven't read that. I haven't read that yet. But I'd like to. Maybe you can forward that off to us.
Yeah, I'll definitely send it. Maybe we can discuss it next week because I think that there's definitely some important implications here for our industry. And I love watching people who have a predisposed notion of one theory or the other. Both sides jumping on this and going, aha, see, I told you. That's exactly what's going to happen. So I guess we'll pick this one up next week. But again, if anybody out there is watching it, it's called CIBC Economics' report on Canadian housing and the dangerous demographics.
Before we go,
yeah,
with 2 seconds, the CMP's top 75 came out, which if you're a big producer and you don't submit your name, you don't make the list. So we all take it with a handful of salt. But I just want to give a quick shout out to my broker Nick. With the Mortgage Wellness Group, we placed 21st in Canada. Nick, I love you. Keep up the great work. That's it.
Hey, great job, and yeah, congratulations to everybody on that list. It's a big accomplishment, regardless of whether or not there's pooling involved, and that's always the one point of controversy people will bring up is that a lot of the names on there are pooling, and I always feel bad for the guys out in Prince Edward Island who do 600 transactions a year with, their assistant Betty, who's been in the business for 70 years, and somehow they managed to crack the top 50 barely. So congratulations to all the people doing lots of transactions.
We can learn something on efficiency from them, I'm sure.
Yeah, oh, no kidding. Yeah, if you could take the efficiency of a maritimer and put them in a market like Vancouver or Toronto or Calgary, watch them climb that list in a hurry. So anyway, congratulations to all the hardworking brokers out there who are on that list and those who aren't. And looking forward to chatting with you guys again next week.
Thanks, guys.
Goodbye. Oh, he left.
It's gone already.